If you go on Amazon, you'll find thousands of investment books, each with a different promise, and part of you will want to read them all and become the best investor you can. Unfortunately, your time is limited. So what investment book would you read if you could choose only one? Warren Buffett, who in 2021 has a net worth of $109 billion, once said that The Intelligent Investor is by far the best book on investing ever written. So let's just say it comes highly recommended. What makes this book so special is not only the content, but also the number of people it has influenced since the first edition back in 1949. But before we dive into the most important takeaways from the book, let's establish the two main characteristics of intelligent investors. Number one, they have a rational framework of making decisions. And number two, they prevent their emotions from overriding the framework. And bonus number three, they smash the like button. And maybe that doesn't make you a better investor, but hey, who knows, might as well do it. If you acquire these two elements, you will likely do better than someone who has more experience or is better educated but lacks patience, discipline, and emotional control. Now, there are two types of intelligent investors: defensive investor and an aggressive investor. Defensive investors want to avoid spending too much time on investing. They're not always passionate about investments or money, and they like simplicity. Their goal is to avoid mistakes and perform in line with the market. Aggressive investors, on the other side, are willing to devote serious time and energy to researching stocks and selecting the good ones. They enjoy thinking about money and see smart investing as a competitive game they want to win. Their goal is to achieve better returns than the passive investor. Usually that means about 5% extra per year. And both approaches can lead to great results. The key is choosing the right type of investment for your temperament and your goals, sticking with it over your entire investment timeline, and keeping your emotions well under control. If you fall in the defensive category, here's how the author suggests you go about investing. And it might sound weird, but defensive investors should not choose stocks at all. Choosing a stock will involve time, research, and a higher risk. If you're a defensive investor and you want to avoid all of that, you should consider buying an index fund, representing a broad swath of the entire market. This will provide broad diversification, and your performance will most likely be in line with the overall market. Still, if you're a defensive investor and you want to choose your own stock, you should follow these criteria. 1. Diversify your wallet. This means splitting investments between stocks and bonds. The default split is 50-50 between stocks and bonds. Number 2. Size matters. Small companies face more volatility and may be unable to survive bad events. So if you're a defensive investor, you should try to buy stocks of companies with a market value of at least $2 billion. Number 3. Choose profitable companies. Companies that have made a profit for at least 10 years are the ideal target. Number 4. Dividends are a good thing, so choose companies that pay dividends regularly. And number 5. Buy all of the above at a reasonable price. The book advises that the price to earnings ratio should be no more than 15 times the average past 3 years of earnings. If you open Yahoo Finance, you'll quickly see that when you follow these criteria, you'll be cutting away the majority of the stocks. And this happens because most of the time, most stocks are likely not good choices for the defensive investor. And that's okay. Remember that you can still make money even if you're cautious. If you think that's not you and instead you want to devote serious time to research and you want to achieve better returns than the average, you're an aggressive investor. Now, when the author talks about being aggressive, he does not mean someone who's careless or impulsive. By being aggressive, he suggests an investor who should methodically value potential investments, be patient for bargains, and maintain level-headedness when the market is reactive in either direction. And if that's you, here's how you should invest as an aggressive investor. Number 1. Size does not matter. While you can still limit your risk by avoiding small companies, you should be on the lookout for good opportunities and open to investing in any company regardless of the size. Number 2. Short-term earnings. You should ensure that the company was profitable for at least 12 months. Number 3. Short-term dividends. It's always a plus if a company paid some dividends recently. Number 4. The price to earnings ratio should be no more than 9 times earning from the last 12 months. And number 5, you should always do your own deep research. And regardless of what type of investor you are, remember that there is no such thing as good stocks or bad stocks. There's only cheap stocks and overpriced stocks. And here's some tips from the book regarding stocks. A strong company is not a good investment if the stock is overpriced. A stock at a low price is not a good investment if the company has poor future prospects. And a stock with tremendous hype around growth and high prices to match it is likely too speculative for an intelligent investor. Now that you know the basic characteristics of an intelligent investor and whether you're a defensive or an aggressive one, you're ready to go out there and buy your stocks, right? Not so fast. Before you go out there and start investing, you should meet Mr. Market. And who better explain the concept than Warren Buffett, who in the 1987 letter to Berkshire Hathaway shareholders unfolded the concept for all of us. He said, "You should imagine that market quotations is coming from a remarkably accommodating fellow named Mr. Market, who is your partner in a private business. Without fail, Mr. Market appears daily and names a price at which he'll either buy your interest in the company or sell you his shares." And he goes on to explain that even though the business that both of you own may be stable, Mr. Market's quotations are not. The poor fellow has emotional problems and his quotations will represent his mood rather than the actual value of the company. So it's important not to let yourself go by Mr. Market's quotations and beware that the success of a company is not defined by his daily or even yearly price quotations. Instead, success is defined by operating results, and this is what your research should be based on. Graham ends The Intelligent Investor with one of the most famous concepts, margin of safety. In a simple way, the margin of safety is a measure of how much you can go wrong before an investment goes bad. Basically, the price of a stock rarely equals the value of the same stock. This means that most of the time you're either overpaying or underpaying for a stock. Having a margin of safety will minimize the risk of being wrong. The question is, how do you know the value of a stock? And the book suggests the following formula. V in this case is the value expected from the growth formula over the next 7 to 10 years. EPS is of course the trailing 12 months earning per share. 8.5 is the PE base for a non-growth company. And G is the reasonably expected 7 to 10 years growth rate. You should remember, however, that the book was written many decades ago and stock used to be cheaper at the time. So in order to have an accurate calculation, many specialists suggest the following formula. In this case, 4.4 is the average yield on a high-grade corporate bond in 1962 when the formula was first introduced. Y is the current average yield on a 20-year AAA corporate bonds. Now let's use the formula to calculate the intrinsic value of AT&T. In the time of the calculation, the actual price of the stock was about $41 US. The EPS is 2.35 and you can find this information from almost any stock website. G is 4.8 and Y was 3.59. This information was taken from the Nasdaq website. Using the above formula, the value, at least in the time of creating this video, of AT&T was 52.13. And in this particular case, since the intrinsic value is higher than the actual price per share, it is likely that AT&T is considered undervalued by this metric. And since the nature of a stock's valuation is to revert back to the mean over time, you should try to buy undervalued stocks and avoid overvalued ones. Now, go out there and develop a rational framework for making decisions. Learn how to control emotions and understand what type of investor are you. Above all, watch out for Mr. Market and ensure a proper margin of safety. And I know some of this might sound super complicated, and some of it is, but the good thing is you don't need to actually invest your own money if you're unsure what and how to do it. Do some paper trading, practice a little bit, understand the concepts, see if you're defensive or aggressive, and only once you're comfortable with the entire concept of investing, actually putting some money on the line. And when you do that, start with a small amount. By all means, please do not invest more money than what you can lose. This is just common sense, but it goes without saying. And if you like this video, you're gonna be super excited about what's coming out next week. There is a new video coming out each and every week on personal finance, on productivity, on self-improvement, on how to live a better life, getting the best ideas from the books, summarizing them, providing them back to you so you can implement them faster. So click on the subscribe button, join the family. I'll see you in the next one. Until then, become an intelligent investor and have an awesome day.